Hey, good morning. This is Jerry here at Wealth Dynamics, coming to you live with my green tie on today. And I wanted to just give you a quick look back today. I'm going over the last 5 recessions we've had, and I want to give you a quick look back to the 2002, actually we're going to go 2000 through 2002 recession, so we can actually get a very, very good understanding, because this was a 3-year wave, guys. It wasn't 9 months, it was 3 years. So I want to get a good understanding of what happened. So this recession, it lasted from 2000 through 2002. Of course, there were some ups and downs during that time, but there were 3 years straight where the market was down, right? And so I want to kind of dive into it. So the first thing about that recession that we need to understand is that it started out with the tech bubble. Okay, it started out with the tech bubble. In 2000, late 1999, going into 2000, the internet was relatively new and booming. Okay, we had all of these online businesses. This was not, this was before e-commerce and all of the stuff that people easily access today. So the idea of, a business operating online was huge. And so because these companies were innovating in the space, it drove their valuations up, it drove their stock prices up. And, anybody could pretty much pick whatever tech company they wanted to invest in, and they were going to make money during the tech bubble. A lot like real estate, pre 2008. And so what happened was a number of things. Number one, the bubble failed. The tech companies, a lot of the big players actually went bankrupt. They went out of business. They weren't around anymore. And what that did is it actually pierced the bubble by showing that the valuations didn't always match the earnings, and that the valuations on these companies weren't as stable as everyone thought. So there was kind of doubt in the marketplace, and what that did is it drove stock prices down. Now, simultaneously, we had several large companies commit financial fraud. So if you guys remember Enron, this was around the same time Enron and several other companies got caught basically cooking their books to drive their share prices up and to make their earnings look higher than they really were. And so this also kind of unleashed the beast on the stock market, and it drove the market downward. So you have a culmination of these things happening, 1999, 2000, in that spot, right? And so the market got hit. It was still recovering. And in 2001, we got hit with 9/11. So imagine that. Like, imagine 2008 happening. If you guys don't remember 2000, if you weren't paying attention, imagine 2008 happening, and just as you thought things were starting to recover, we get hit with something like a terrorist attack, and it just pummels the market again. That's what happened in 2001. Okay, and this was really kind of in the middle, and it spurred the tech bubble on further, all the way through to 2002. And so the tech bubble lasted until then, because we still had the after effects of these calamities going on in the marketplace, with the misvaluations on companies, fraud being committed, bankruptcies happening, 9/11 terrorist attack, kind of just grabbed this entire period and extended it for 3 years. Okay, now here's what I want to point out. The market was down for 3 years in a row. Those of you that say, oh, just wait, it'll come back. If you lost money in 2001, I believe you would have lost about 11% in 2000. Okay, you would have needed to make 22% in order to actually make your money back. If you lose 11% and then you make 11%, you're not back to break even. You're 11% above what you had when you lost. You actually need to double that if you want to bring it back up to a break even. So in order to break even, you would have had to make 22% at least. Okay, in 2001, you did not make 22%. I think you lost like another 3 or another 9 or something like that. Okay, in 2002, you lost again, meaning that you were down 3 years in a row. If you're measuring the growth of your portfolio, you have to measure it in dollars and not percentages. So in 2003, the market did come back up, but you didn't. Your portfolio didn't. Just because the market was up doesn't mean that you had more dollars in your 401k than you started with prior to the year 2000. That's critical to realize. And I want to point out again the congruence here. A recession happened, the market went down. If you were in mutual funds at that time, you lost money. If you were in your 401k at that time, you lost money. If you were in your IRA at that time, you lost money. And if you lost money then during a tech bubble, what's going to happen if it's a cryptocurrency bubble, or a housing bubble, or a student debt bubble, or the financial market collapses because we've got all of this disruption happening between global cryptocurrencies and central banks competing with large corporations for control over the next monetary system. What are you going to do then? Because if you're still sitting there in mutual funds, you're going to lose money again. And that's why people don't get wealthy. It's not because they're dumb. Okay, if you keep repeating it, you kind of are dumb. But it's not because people are innately dumb, though, and they don't know what to do and they're making all the wrong choices. Yes, there is some degree of bad financial behavior, but the reality is the three vehicles that you're being taught to save money in: Wall Street, your home, and the bank. Wall Street and your home, they lose money every 5 to 8 years. So if you're stacking money in your home equity, that's why you're losing money. Every 5 to 8 years, your home equity goes down. If you're stacking money in your retirement plan, that's why you're not wealthy. Every 5 to 8 years, your retirement plan gets cut in half. And if you're leaving money in the bank, that's another reason you're not wealthy, because you can't be getting wealthy off money that the bank's getting wealthy off of. Let's face it, they're lending the money out, they're not paying you squat, and you're just sitting there on the sidelines. So that's what I wanted to share with you today. A look back at the 3-year period. This was one of the biggest and longest hits we've had from a time extension standpoint. We don't have very many records of 3+ years in a row of the market being down in recessions. That was an interesting one to study. So real quick, guys, by the way, I did make a free masterclass that I want to give you access to. And so if you click on the link in the comments, it's jerryfetta.com/recession. Again, that's jerryfetta.com/recession. If you click on that link, I made a masterclass that's completely free, costs you nothing to access, and it's going to give you a 6-module series on the last 5 recessions, of what caused them, how they were caused, what the result was, who made money and who lost money, and then B, where you need to be positioned during this next one. Okay, there are particular asset classes that are going to hold their ground and not lose money, and there are particular asset classes that historically, they lose money every single recession. So if you don't figure out where to position yourself, you're going to stay in these asset classes that hemorrhage losses every time a recession happens. And guess what? That's exactly what's going to happen to you during the next one. So if you want to avoid that, I want to give you some free information. If you'd like to check that out, again, that's jerryfetta.com/recession. Make sure that you like, share, and subscribe. I will talk to you soon.